So you're getting close to retirement and you want to build your own asset allocation portfolio. You have questions like, how much can you make or lose with a 70-30 equity to fixed, or a 60-40 equity to fixed, or even a 50-50 asset allocation? You're curious about what your expected return should be for different asset allocations, and also what the worst case should be. What is the most amount of money that you could expect to lose in a terrible year? I've been managing money for wealthy families for over 25 years. I've built hundreds of asset allocation portfolios. That experience and that empirical data set is what I rely upon for the information that I'm about to share with you. This presentation is going to be in two parts. In the first part, we're just going to have a general discussion on asset allocation concepts, important variables that you absolutely need to consider when you're building your own retirement asset allocation. Then we're going to look at 4 different asset allocation models that I have designed to show you what kind of returns you can expect under various asset allocations. What is the worst case that you should expect, i.e. worst 1-year loss for different asset allocations, and how much you could make in a great year with different asset allocations. Knowing what to expect, in my opinion, is a very important piece of a successful retirement plan. When designing your own retirement asset allocation, there are 3 variables that you absolutely need to get lined up. Those variables are your time horizon, your risk tolerance, and your return expectation. It has been my experience, after having met over 300 wealthy families throughout my career, that the majority of people do not have these 3 variables in alignment. It sounds simple, but it's more complicated than people realize. You need to have a really strong understanding of investments, how much they can make or lose under good and bad situations, what kind of return you should expect, before you can get these variables lined up properly. When we look at the 4 models I'm going to show you, I think it's going to be very helpful for you to line up your asset allocation with how you feel, your risk tolerance, and the returns that you're looking for. I think this is going to be a very helpful video for you. In addition to getting your asset allocation strategy set up properly the first time, there are 2 other important decisions that you have to consider when building your own asset allocation. Number 1, will you need to spend capital gains or principal out of your portfolio, or will you just spend the dividends and interest income, bond income, etc., that the portfolio generates? That's important for you to consider. If you need to rely upon capital gains and spend a portion of your portfolio's principal over time, then you will want to be very careful with just how much risk you are taking in your portfolio. Capital gains cannot be relied upon. You can't generate them every single year, year in and year out, like you can dividends and interest. So when using your asset allocation for capital gains as part of your income stream, you want to be careful with how much risk you take. If you take too much risk and you lose a bunch of money, you can turn your whole retirement upside down pretty quick. Conversely, if you are only spending the dividends and interest off the portfolio, you could take a little bit more risk. I think a lot of people don't realize that, but if you are only spending dividends, then you won't be as concerned typically with the valuation movement of your portfolio as it fluctuates up and down. Not such a big deal if you're only spending dividends and interest off the portfolio. But if you need capital gains, when the portfolio goes down, it's a big problem. The second decision that you need to consider for your retirement asset allocation is, will you stay invested at all times, or will you employ tactical asset allocation strategy where you might maneuver in and out of the market for a portion of your portfolio or substantially change the asset class weightings? If you choose to do that, it can really hamper your returns if you make bad market timing calls or you are wrong on your asset allocation tactical weightings. In my experience, you're generally better off to stick with the big picture, keep your asset allocation weighting static, rebalance them periodically, and make minor changes over time, moving from growth to value or value back to growth, getting out of long-term bonds, shifting into short-term bonds, things like that. But keep the big picture in place. If you are set on a 60-40 equity to fixed, keep the equity to fixed ratio, but moderate the style of equity and the style of bond investment. Don't get out of the market in a big way, because if you get that wrong, it can really mess up your returns. For example, let's say your portfolio is balanced at 60-40, but because you think AI is going to take off, you move to 80-20. Or because you're worried about a market crash and a recession, you go to 20-80. And in either of those cases, if you end up being wrong, you could A, lose a lot of money, or B, get left behind if the market goes higher and you're overly conservative. In either case, if you make a big market timing call, a big strategy shift with respect to your asset allocation, you could potentially mess up your returns for a long period of time. So I think you're far better off to stick with the big picture, a 60-40, for example, and change only the underlying investment styles. Don't abandon your asset allocation if the future gets volatile. The whole point of having an asset allocation is to deal with an uncertain future. So when we look at these 4 models that I've built for you, I think it will help you find the one that's most comfortable for your situation. And the whole point of financial planning is to pick an asset allocation and stick with it. That's another concept or another thing for you to think about, that financial planning, I know a lot of you are using financial planning tools, assumes that you will stay invested the entire time. So once you start market timing or making big changes to your asset allocation, it really messes up your financial plan. Your probability of success may come way down. So be sure to get your asset allocation right the first time so that you can stay invested. The last thing that I'll add for picking an asset allocation or asset allocation in general is be aware of the fact that sequence of returns risk is very high for a 30-year period. If you are planning on a 30-year retirement, your probability of encountering a sequence of negative returns event, which means at least 2 and maybe 3 or even 4 negative return years in sequence, your odds of that happening are 97% based on past data. If we go all the way back to 1871, there have been 125 30-year investment periods. 122 of those periods had sequence of returns risk. That's 97% odds. So it's very likely if you are 65 years old today and you're planning on a 30-year retirement out to age 95, at some point over the next 3 decades, you're going to get hit with a sequence of negative returns event. We don't know when, we don't know how deep or how many years, but when it happens, then you might lose more than you expect. So you want to incorporate that into your planning. For instance, most people will pick an asset allocation based on 1-year volatility. What's the most that they could lose in 1 year? Worst case. But if we have 2 or 3 negative years in a sequence, you will lose more likely than you would under any one given year. So make sure that you at least tuck that away in the back of your mind, so when that event happens, you don't sell out and you don't get out of the market. Okay, let's talk about these models that I'm going to show you. We're going to look at a 50-50, a 60-40, a 70-30, and a 40-40-10-10. The 50-50 is going to be the S&P 500 total return and the aggregate bond market total return. We are going to look at a 30-year return scenario for that model, and I've rebalanced the model annually. So all of the others have also been rebalanced annually. The others are 60-40, S&P 500 total return, bond market total return. The 70-30 is S&P 500 and bond market. And the 40-40, 10-10 is going to be 40% S&P 500 total return, 40% bond market total return, 10% commodities, and 10% real estate. They're all over a 30-year period, so we're looking at 1995 through 2024. And I think it's going to become very easy for you to identify which of these asset allocations feels right for your retirement. Our first portfolio for analysis will be a 50-50 equity to fixed asset allocation. We are rebalancing annually. We're using 50% in the S&P 500 total return, 50% in the Bloomberg aggregate bond total return. I chose a 30-year period for analysis because that is a typical retirement. If you retire at 65, we're looking all the way out to, say, age 95. This asset allocation, rebalanced annually over the last 30 years, had an 8.2% total return. The worst year was 2008 at minus 16%. The second worst year was 2022, minus 16%. The best year was 1995, 28%. If you had $2 million in a 50-50 asset allocation in the worst year, 2008, you lost $317,600 that year. Here is the risk to reward scatter plot for the 50-50 portfolio over the last 10 years. The portfolio is the red dot, the bond market is the green dot, the S&P 500 is the blue square. What the risk to reward scatter plot tells you is how much volatility you experienced for the mean return. For the 50-50 portfolio, we earned 7.5% over the last decade, and we had a 9 for standard deviation. That was the volatility measure. If we were in the S&P 500, you see that there was much more volatility, 15, and also much higher return, over 12.6. The bond market had a very low return over the last decade, under 1%, but it also had a much lower standard deviation at 5. By combining stocks and bonds, we are lowering our standard deviation, taking on less volatility, but still getting a respectable return of 7.5% over the last 10 years. Here are the stats for our 60-40 asset allocation portfolio. Rebalance annually, 60% S&P 500 total return, 40% Bloomberg Ag Bond total return, 8.8% compound total return for the last 30 years. The worst year was 2008, minus 20%. Second worst year, 2022 at minus 16%. Best year, 1995, 30%. Loss on $2 million in the worst year was $402,000. Here is the risk to reward scatter plot for the 60-40 over the last decade. Now your standard deviation is moving up because of the extra equity exposure. We're about 10 standard deviation, but notice that our mean expected return for the last decade, 8.8%. We're taking on more volatility, but we did receive a higher return. Here are the stats on a 70-30 equity to fixed asset allocation for the last 30 years. Rebalance annually, 70% S&P 500 total return, 30% Bloomberg aggregate bond total return, 9.4% compound total return over the last 30 years. Worst year, 2008, minus 24%. Second worst year, 2022, minus 17. Best year, 1995, plus 32%. In the worst year, if you had $2 million in the portfolio, you lost $486,000. Here's the risk to reward scatter plot for the 70-30 portfolio. Notice that our standard deviation keeps increasing, and so do our returns. Higher return and more volatility. Now, what happened if you moved beyond just stocks and bonds and included commodities and real estate in your portfolio? This is the model for a 40-40-10-10 equity, fixed, commodities, real estate asset allocation. We are rebalancing annually. We have 40% in the S&P 500, 40% in Bloomberg Ag Bond, 10% commodities index, 10% DJUS real estate, that's Dow Jones. 30-year compound total return, only 7.7%. The worst year was 2008 at minus 20. Second worst year was 2022 at minus 14. And the best year was 95 with plus 25%. If you had $2 million in this portfolio in the worst year, you lost $407,000. Here's the risk to reward scatter plot for the 40-40-10-10 portfolio. Portfolio's right here, red dot. What's interesting is the portfolio has a much lower standard deviation than real estate or commodities, but the returns are better. So this is a much more efficient portfolio when you combine all these four components than if you had just invested, for example, in commodities or real estate. By combining all these parts, you're getting a much better output with the 40-40-10-10 per unit of risk. Here's a summary table for all four model portfolios. 30-year compound total return numbers, the worst year and the best year. You might want to press pause on this slide, study a little bit, and see which one feels best for you. There is something very interesting going on with this data. Can you see it? Look at the 40-40-10-10. And the downside loss worst year is minus 20%, but then look at the 60-40. Same worst case loss, minus 20%. So it really gets you thinking. By adding in commodities and real estate, most people would assume that we're further diversifying the portfolio, and therefore we would expect to have more downside protection in a bad market. But that wasn't the case. And we gave up long-term compound total returns to get that diversification. It didn't work out. We also capped our upside. The best year for this 40-40-10-10 was only 25% compared to the 60-40 that had a best year of 30%. Now I see stuff like this 40-40-10-10 with robo-advisors frequently. They just go and buy everything brainlessly. No thought to future returns or anything else. Let's just buy all the asset classes. But what this shows me is that if you start adding in more asset classes, you may not get the downside protection that you're looking for, and you're probably giving up some returns in the process. If you have questions about your investments, please give my office a call. We would be happy to give you a second opinion on your portfolio. If you like this content, please share it with your friends. I hope this video was helpful. I hope it gets you thinking, helps you better analyze your investments, and overall improve your family's financial plan.